All right, welcome to this explainer. We're jumping right in today, and I am absolutely thrilled to have you here. Get ready, because we are embarking on a really high-octane masterclass that maps out the entire modern corporate life cycle. We're going to take the massive, incredibly complex world of ACCA, everything from advanced financial management all the way over to taxation, and we're distilling it down into a single, high-yield blueprint. No fluff at all, just the exact structures, frameworks, and honestly those sneaky exam traps you need to dodge to conquer your professional exams and absolutely dominate in the real world.
So think about this for a second. What on earth connects the valuation of a massive multinational merger, the exact calculation of UK corporate tax, and the incredibly messy reality of human psychology? Well, let me tell you right now, these are definitely not just isolated exam topics locked away in different textbooks. No way. They are the deeply interconnected gears of a real-world business. A strategic decision made up in the boardroom completely impacts the tax return filed with HMRC, which then changes the performance metrics used to pay our bonuses, which literally alters human behavior down on the factory floor. If you really want to master finance, you have to be able to zoom out and see the whole machine working together.
But wait, hold on. Before we start building out these complex frameworks, you absolutely, unequivocally must master the core bedrock of financial accounting. If your double-entry bookkeeping is even a little bit shaky, or if you don't instantly grasp the accounting equation where assets equal liabilities plus equity, or, if you can't reconcile control accounts, all the advanced stuff we're going to talk about is just going to crumble. You really have to treat these FA fundamentals like the steel foundation of a skyscraper. Lock them down first.
Okay, let's dive into this. Throughout this explainer, we're going to lean really heavily on Rohan's famous one-line summary motif. It is such a brilliant study technique. And why is it so good? Because when the pressure is really on in the exam hall, your brain doesn't need a massive textbook paragraph. You just need a razor-sharp trigger to unlock your knowledge. So we're going to build our modern business using these exact summaries across advanced financial management, performance management, financial reporting, and taxation. All right, kicking off the business life cycle with advanced financial management, or AFM. Say we have a massive new project, right? But how do we actually evaluate the investment? Well, we use APV, and the one-line summary here is absolutely critical. APV equals your base case NPV plus the present value of financing side effects. You are literally separating the pure operating cash flows from the specific way you pay for the project. Why do we do that? Well, because raising debt gives you this beautiful tax shield on the interest, sure, but it also triggers some pretty nasty issue costs. So APV essentially isolates the pure operating value of the business from all the financial engineering.
Sticking with AFM for a minute, we've got to talk about the discount rate. You can't just slap your company's old WACC onto a brand new, wildly different project. That doesn't work. You need the step-by-step ungearing and regearing beta flow. So step 1, you find a proxy company that operates in the new industry. Step 2, you ungear their equity beta down to an asset beta, which completely strips out their specific financial risk. And then step 3, you regear that asset beta using your own project's target capital structure. And please, listen to me carefully on this one. Always use the 1 minus tax formula when you ungear and regear. Forgetting the tax shield on debt is a classic exam trap, and it will cost you easy marks.
And this brilliantly illustrates a massive insight as we shift gears into performance management, or PM. Up to 80% of lifecycle costs are permanently locked in at the design phase. Think about that. By the time you actually hit production and distribution, the vast majority of your costs are totally decided. If you're waiting until the product is on the factory floor to start cutting costs, it is way too late. You absolutely must manage costs from cradle to grave.
Since those costs are locked in so early, we use something called target costing. Imagine the market is basically dictating your selling price, and your shareholders are demanding a very specific profit margin. Selling price minus that desired profit equals your target cost. Let's look at a quick example. Say our target cost is £50, but our current estimated cost is sitting at £60. We've got a £10 cost gap. So how on earth do we close it? We use value engineering right at the design phase. We simplify the design, we standardize the components, and we relentlessly negotiate with suppliers before production even begins, just to squeeze that £10 out of the product.
Okay, so once production actually starts, overheads just start piling up, right? Here is a rapid-fire comparison. Traditional costing basically just dumps all your overheads into products based on simple volume, like labor hours. Honestly, it's outdated, and it's wildly inaccurate for complex businesses. Enter ABC, activity-based costing. The one-line summary here, ABC is about activities, not just volume. We assign overheads based on the actual cost drivers, things like the number of machine setups or the number of quality inspections. It gives management the incredibly accurate data they desperately need to stop accidentally subsidizing highly complex, unprofitable products.
All right, the product is designed and priced, boom. Now we shift into Advanced Performance Management, APM, to measure our strategic success across the entire company. You cannot just look at profit. Kaplan and Norton's balanced scorecard demands that we look at 4 distinct perspectives. And here is the real magic of it. It's a complete cause and effect chain. If we heavily invest in learning and growth, our internal processes naturally become more efficient. Better processes lead straight to happier customers. And those happier customers, well, they directly drive the financial results for the shareholders. It's all connected.
So, the crucial point is choosing the right metric when you're judging your divisional managers. Return on investment, or ROI, is a percentage. And yeah, it's incredibly popular, but it creates a massive business pitfall called sub-optimization. Imagine a manager rejects a fantastic new project just because its return is slightly lower than their current stellar ROI, even though it comfortably beats the company's cost of capital. That's insane, right? That is exactly why we use residual income, or RI. RI is an absolute number. It better aligns management with long-term shareholder value because, hey, if a project generates a positive RI, it adds absolute wealth to the business and the manager will definitely take it.
Now, what's really fascinating here is diving straight into the messy, complicated human psychology of budgets. If you design your performance metrics poorly, you are going to trigger dysfunctional behavior. This isn't just a textbook theory. This happens literally every day in the real world. If you set an impossible budget, managers are going to build in budgetary slack by intentionally padding their estimated costs to protect themselves. If you link a massive bonus strictly to short-term annual profit, managers will absolutely engage in short-termism, literally slashing critical R&D or employee training just to hit the target and grab the cash. If you measure people wrong, they will systematically destroy your long-term strategy.
Speaking of being fair, let's totally reframe a really common exam mistake as a real-world management fix. When actual costs completely blow past the budget, who is actually to blame? Well, we have to split the variance. A planning variance happens because the original standard was just unrealistic due to an uncontrollable market shift, like say a huge global spike in raw material prices. You never ever penalize a manager for that. You only evaluate them on the operational variance, which actually measures their actual controllable performance against that newly revised standard. Basically, judge people only on what they can actually control.
Let's move to and see how this builds into financial reporting, or FR for short. We've managed the internal performance, now we have to officially report it to the outside world. Everything here is governed by the conceptual framework in IS1. All of our incredibly complex operations, all our asset purchases, all our sales revenues, they all boil down to these 5 official elements: assets, liabilities, equity, income, and expenses. This framework is essentially the universal language that tells investors and creditors exactly how well our modern business is surviving out there in the wild.
And hey, because we've generated all this wonderful profit, the government obviously wants its cut, right? Let's hit the taxation rules, specifically the 2025/26 rates with punchy, rapid-fire speed. If your company profits are 50 grand or less, you pay the small profits rate of 19%. Nice and simple. If you're a heavy hitter pulling in 250 grand or more, boom, you're hit with the main rate of 25%. And the one-line summary for everyone caught in the middle? Any company generating between 50,000 pounds and 250,000 pounds falls straight into the marginal relief band, which requires a very specific formula to calculate your exact effective tax rate.
But listen, knowing the tax rate is literally only half the battle. The other half? Strict compliance. You've got to keep this timeline totally fixed in your mind. From your financial year end, the clock is officially ticking. You have exactly 9 months and 1 day to actually pay your corporation tax to HMRC. But interestingly enough, you have a full 12 months to officially file your CT600 tax return. Mix those dates up and you will get hit with automatic fines and some really nasty daily interest penalties. Cash flow management right here is absolutely vital.
Actually, let's take a quick breather from the technical finance for a second. I want to highlight Rohan's ultimate meta advice for studying. Reading these notes is great, absolutely, but it's just not enough. You must attempt the mocks on the ACCA practice platform. Sit down, start the timer, and literally do not pause it. Once you finally finish, review your answers deeply. The quote here says it all. You will learn more from your mistakes than from any notes. You've got to let your brain recognize the patterns of your errors. That is exactly how you turn weak spots into completely bulletproof exam technique.
So we have walked through the entire blueprint, everything from valuing an investment with APV to stripping out costs in the design phase, to measuring management behaviors fairly, reporting to the market, and finally settling up with the tax man. The architecture is all right there. The only question now is, are you ready to build, measure, and report the ultimate modern business? Go fire up the practice platform, apply these one-line summaries, and go conquer your exams. Thank you so much for joining me on this explainer. Stay intensely focused, and I'll catch you next time.